IBIT has resonated so much more with investors, particularly institutions?
Yeah, it's been quite amazing to see, frankly. Obviously, we had high expectations for this, but not to the full extent of what we've seen. And what's happened is IBIT is overwhelmingly resonating with investors of all types in terms of a preferred Bitcoin exposure vehicle. Of course, there's lots who do and will continue to hold directly, and that's great and healthy to have lots of options in the market. But for institutions, it's made this a very turnkey, accessible, convenient way of holding it through trusted providers, not having to worry about operationalizing custody for financial advisors. It's a way of helping their clients consolidate assets onto their platform, be able to do things like borrow against it, do tax and estate planning with it. And even for lots of retail investors, they're finding it just to be a convenient, low-cost, preferable alternative.
What kinds of conversations are you having right now with institutions about allocating to Bitcoin ETFs? And are these mostly hedge funds, pensions, or RIAs dipping in for the first time?
Yeah, well, the biggest conversation gets back to what you alluded to at the start, which is trying to understand the risk and return drivers of this. Because when you look at it fundamentally as a global, scarce, emerging monetary instrument that looks a lot like digital gold to many people, and that is detached from the risk factors that affect any one country or their economy, monetary, political, fiscal situation, et cetera, that looks like a diversifier and a hedge on a fundamental level. But then you see this noise in terms of short-term trading episodes where people talk about risk on. That's a bit of a dubious concept to begin with. But especially so when you try to apply it to Bitcoin, because Bitcoin clearly is a risky asset on a standalone basis, but in a portfolio and with very different return drivers, it can play that important diversifying role. So you see these episodes where you have the leveraged perpetual futures kind of create outsized volatility relative to what they really are as a percentage of the market. And that gives institutional investors pause. And they say, well, we kind of get the thesis, but we really need to understand where do we think long-term correlation's headed and is actually going to behave the way we think it fundamentally should. And our view at BlackRock is over the medium and long term that it will, but certainly institutional investors are paying a lot of attention to some of that trading behavior. And ultimately, we see those two worlds converging in a way that kind of brings forward the best properties of both.